Hey, welcome back to Harvesting Income. Hey, today we are going to talk about an interesting argument about the covered call strategy, and that's why the title is Covered Call Option Strategy. There are two arguments about it. One argument is like it is difficult for a person or an individual to execute that strategy. It's complex, difficult to execute, and so on, which I agree to some extent, and and myself included, it's difficult for a individual to execute it on their own. And second argument is about covered call funds, and this is the focus of the video. The second argument is about covered call funds, which are seemingly kind of funds which are not making any money. They are actually limiting your profits, and also they are funds which are scams and they are returning back your capital. You invest money in them and you get it back in the form of dividends. So it's they're just paying your money back to you, and so on and so forth. Of course, there are some good funds and bad funds in every category, including covered calls. But in this video, I'm going to just demystify this and then show you what covered call option strategy is, how does it work, and can it really make money for you? And then we can see, how valid those arguments are. Uh, so let's get started. Okay, before we go ahead, this is only for knowledge purposes and nothing is investment advice. So consult a professional for any investment advice. Okay, why the covered call option? Why the idea? So I have an asset, let's say a stock, which is called hypothetical blue chip stock, purchased at $100. This is just for an example. I'm positive about the company, but I'm not going to wait for appreciation and it pays me little dividends. This is the situation. Like many people face this. Like you got a stock, you invested in it for long term, but you're getting a small amount in dividends trickling maybe a few dollars here and there. And once in 3 months, 6 months, you get some dividend. And you're not seeing any kind of results or it doesn't pay you anything back. The returns are paltry and not life changing. I need some money on a regular basis from investment, not sit and wait for a home run. Like you hope that that stock will double or triple or something will happen, but nothing happens. So this investor says I write a covered call to generate that income. So that's why this strategy or this idea came about. And it could be done in two ways. One is you can write your own covered calls on your stock, or you can invest in a covered call fund or ETF. I will explain to you different scenarios. Like before we get into the exact funds and all that, I'll explain to you three different strategies. So for this example, like there is a TV show, Marketeers, where there are three different people like who have three different strokes, three different strategies. So Warren, Tom, and Smith, these are the chief guests of the show. And Warren is a long-term investor, and Tom is a trader, and Smith is a kind of seasoned investor. He uses covered call strategy. So he's a covered call investor. So Warren says, I research the company and its intrinsic value. I will hold as long as the underlying business is good. He's a typical long-term buy and hold investor. Tom, the trader, is a typical trader. He says, hypothetical blue chip is one of my recent trades. I made about 2% a month from writing calls on similar stocks until it gets called away. He's just writing calls as a part of his trading strategy. And he's into trading. He's not invested into the company or he's not going to buy and hold forever. And he moves on from one stock to the other. He's not going to be married to a particular stock or holding on to a stock for a long period of time. He's going to hold it only as long as his trading is being executed. And once his trade is closed off and he's moving on to the next one. That's Tom. The third one is Smith, a covered call investor who says, I will hold the stock as long as it doesn't hit my target. He seems to be similar to Warren, but he's saying one small point which is different. He's saying that he will hold the stock until it hits a certain target. He sets a target profit or target price, and he's willing to wait until the stock hits that. And once the stock hits that point, he would like to sell and take the profit out and move on. So that's his strategy. And until then, he's okay to wait for that. So he says, when target hits, I'm going to sell and move on. So let's look at each of them. I will explain these strategies in the upcoming slides for each of them using an example so that you can get a better picture. So Warren, he invested in the stock at $100. So Warren buys a stock at $100 and simply holding it. So let's say 1 month later, at the end of the month, let's say the stock price moves to 105. So 100 to 105, Warren made a profit of $5. So that's the profit he can make. If it moves to 110, 20, depending on how much it moves, he makes that much of profit. And he's not selling it because he's still holding the stock, so it's a notional gain. Similarly, if the stock price falls, he makes so much of loss. Like for every dollar the stock moves below 100, he makes so much of loss. So if the stock moves to 95, he makes a loss of $5. If the stock moves down to 90, so he loses $10. So basically the maximum gain is unlimited because it can go up to infinity theoretically, and it can go down all the way to zero. So maximum that he can lose is $100, and the break-even point is 100. If the stock stays at 100 at the end of the month, he made no profit, no loss. He's break even. So that's the story of Warren. And let's move to the next one. This is Tom. Tom's strategy is different. Like I said, he's a trader. He's not invested in the stock. He writes HBC call at 102 strike price. So 102 is the price at which he wrote the call, which means that he has the obligation to sell the stock at 102 because of the call writing. So on the call writing, because of his obligation, he is given the premium $1 on the trade because he's obligated, like he doesn't have a choice. He has to deliver the stock at 102 because of the call writing. And if the stock remains at 102 or lower than 102, like let us say the stock is remaining at $98. In that case, Tom collects the $1 premium and he made the $1 profit and he moves on. However, if the stock price were to rise above 102, let's say the stock price moves to 105, in that case, Tom is actually losing $3 on the stock. And if the stock moves to 110, he's going to lose $8. The stock moves to 120, he's going to lose $18. So since he sold at 102, like he sold the option at 102, his losses above 102 can get unlimited. Like can as long as the stock keeps rising, his maximum loss is unlimited. Whereas his maximum gain is only $1. He gets $1 paid upfront for that risk that he's taking. He's basically acting like an insurance company, taking on the risk and getting that premium paid upfront. And his break even is 103 because at dollar 103, he's losing $1 on the you know recall position, but he already earned $1 premium. So minus one plus one, it's zero payoff at 103, and at 104 onwards, he's losing money. That's how the naked covered call option works when a naked covered call is written or sold. And in this example, we are assuming no transaction cost, no margin cost. Simple example. So this is a very risky trade, and this is only for professional investors who can do this. And this is how the naked call writing works. The next strategy will be a mix of what Warren did plus what Tom has done. So it gives a kind of a different flavor to the whole option writing strategies. So let's look at the next one, which is the strategy followed by Smith. So when you look at Smith's, strategy, it looks very complex in the initial part of it. So because I have also put Warren and Tom in the payoff diagram. Warren is simple. He bought a stock at 100, unlimited gains, can lose the entire money he put on the stock. So it's like a straight line. For Tom, the blue line, it's basically limited profit at $1. And if the stock price keeps moving up, he loses above 103. Like his losses are unlimited on the right side when the stock price moves up. But if the stock price remains flat or it goes down, he makes that $1 premium. So that's his strategy. Now, Smith, what he does is he bought the stock just like Warren, and he also wrote the covered call on the same stock at 102 and earned the $1 premium. So let's say the stock remains at 102 at the end of the month. So in this case, what happens? He bought the stock at 100, so he made a $2 gain on the stock appreciation. Plus, he made $1 on the premium because he wrote the call option. He got premium of $1. So 2 plus 1, 3 is the profit he made at 102. So as long as the stock price is 102 or higher, he's pocketing the $3 premium. That's the maximum gain he can make, not more than that. If the stock moves to 105, he made a $3 gain on the stock, but he lost on the call option position because he sold the call. He's obligated to sell at 102. So even though the price might have moved to 105, he's obligated to sell at 102. So basically, the stock price gain and the call option position cancel out their, you know, profit and loss. So basically, it remains flat at $3 above 102. And what is the break-even point? Point where he makes no profit, no loss, and then we can look at the loss potential when the price goes down. So break-even point is at 99. If you see here 99, it's almost at zero here. The reason for that is he made $1 loss on the stock, $1 loss because stock moved from 100 to 99. But the premium earned on the option, $1, is compensating that loss. So basically, instead of making a $1 loss, he's making zero loss at 99. So if we are in Warren's case, Warren is losing $1 when the stock moves to 99. However, Smith is not losing any money. He's breaking even at 99. So Warren is breaking even at 100. Smith is breaking even at 99. Okay, let's look at a good example now. Let's say the stock moves from 100 to 96. So Warren is losing $4, whereas Smith is losing only $3. Why? Because he earned the $1 premium. So the yellow and green lines are parallel to each other, but the difference is pretty constant, $1, because the $1 earned by Smith is giving him that kind of cushion. So yeah, so if you are following this, you can see that the green line is the payoff for Smith. And while the downside of Smith is similar to Warren's downside, similar to stock downside, as in the case of Warren, he's he's able to cushion it by the premium, and his upside is capped at $3. For Warren, there is no upside cap because he invested in the stock and he can make unlimited gains theoretically. If the stock price moves above 104, he keeps making more gain. 110, he makes $10 gain. 120, he makes $20 gains. So this upside potential is unlimited for Warren. So his idea of holding long term works for him. But for Smith, he has a limited upside. So that's the drawback of covered calls. We'll touch upon this detail later, but this is how it works. So the green line you see, limited upside and also unlimited downside. That's how a covered call works. However, this is a blue chip stock, and Smith and Warren have strong conviction in the stock. So that's why they're not too worried about the downside. So that's another point to keep in mind. So with this, I will just now touch upon the next area. What happens after the 1 month once the call expires? Call option is going to be lasting for 1 month in this example. There are two things which can happen: call exercise, or the call gets exercised or closed, or the call expires worthless. So if the stock price moves above 102, the call gets exercised, and the call writer has to give the stock to the call buyer on the other side. So the position gets closed at 102, regardless of where the stock closes. Stock goes higher, it gets closed at 102. You made the loss, and in either case, like the covered call writer who is Smith, he has a profit capped at $3 if the stock keeps moving up. Because he has a $1 premium plus the appreciation $2. And after this stock gets called away, he sold his position, he made that limited profit. He can do a similar strategy on the same stock or a different stock. Now he has the money to move on to the next strategy. Smith, let's say in the second scenario, if the stock stays at 102 or lower. So in this case, Smith keeps the stock and earns the $1, and the call expires worthless, and the call position is closed off, and his stock remains in his account. So in the first case, the stock was sold off or delivered to the other party. But in the second case, the stock stays in his account. He's pretty good. Okay, so in either case, like he's not losing much. The second scenario is more interesting because he can, once he makes the premium, he has the stock and he still earned the premium. It's basically like having a house and you put it on rent. You're making the rental income and you have your house which is appreciating in price. That's the second scenario. But in the first scenario, he is forced to sell off the stock or the underlying asset. And we will look at more pros and cons of this strategy as we go ahead. This is just to give you the two different scenarios. There is a third scenario. We'll look at that also later on. Smith strategy, we have this maximum gain is $3, as we saw, $2 appreciation plus premium. Maximum loss is 99, $100 loss minus plus the premium $1. That's the maximum loss. Smith says in the TV show that this is the worst case scenario, but it's much likely. I did research on the company like Warren does, so I don't think this will happen, but this is the worst case scenario. And there is an element of risk, and he's trying to be more upfront about that. So, what if the stock price goes down? So, in the previous example, we saw the stock price remaining flat or remaining going above. But what if the stock price goes down dramatically? I lose money, unrealized loss, like you said, worst case scenario, you can lose everything. However, I earn premium income, which is offsetting some loss. The recurring monthly income helps me hold long term. So basically, he's earning premium from the stock and he's continuing to do this strategy every month. That helps him over the long term. The offset of the loss premium income is very small. So it doesn't cover the loss fully, but provides a shock absorber, cushioning or buffer effect. Just these are the words of wisdom here from the expert. He says that the premium income is too low. It doesn't cover my loss. However, it provides me that shock absorber or the buffer or the cushion effect, which helps me stay grounded. This is exactly what the critics are talking about. Critics are saying, "Oh, the covered call doesn't protect your downside." True. The covered call doesn't magically make your portfolio better. True. But it definitely reduces volatility, provides you the shock absorber. To give you an analogy or an example, like it is not perfectly comparable. Let's say you have a wonderful SUV and you're going on a 6 hour trip somewhere and you want to go on a long trip and then you're driving. If the vehicle has a good shock absorber, it's going to give you a smooth ride for a 6 hour journey. Like you're moving from one city to the other and you're having a lot of roads. Like some roads are good, some are bad, some are slippery, some are like potholes, and you have a lot of bumpy rides and speed bumps, blah blah, so on and so forth. And you need the shock absorber to make the ride more smoother. Not only that, to make the vehicle's body or engine more, you know, uh, more insulated from the volatility or the shocks that it is getting from the roads. And similarly, even the parts of the vehicle have to be protected from those, you know, kind of erratic, volatile situation that you have when you go on potholes and so on. And similarly for your body as well, when you're traveling, you want to have lesser shocks, lesser, impact, whatever it is. That explains the same thing when you are investing in the stock. You want to have a smooth ride, right? You don't want to have a bumpy ride all the time. Like you want to have a smooth ride. You want that call option premium helps you to smoothen your ride. Some of you may not find value in it. Some of you may feel that this is valuable. I am a long term investor. I want this. Some of you may feel, hey, I don't care about this. I don't need this income. Perfectly fine. Everybody has their own idea or, their requirements. So, depending on your needs or requirements, you can consider this strategy. So it doesn't mean that this is the perfect one. Depending on your needs and goals, you can choose the strategy. And what if the stock price stays flat? The TV show anchor asked the question. And Smith says this is the perfect scenario. Even though assuming no capital appreciation, I make $1 premium. That is a 1% gain a month, which is not something to laugh about. Making double-digit gains over a year, and that too, a flat stock price. I can hold the stock and also earn the dividends if applicable. That's icing on top of the cake. Holding the stock and getting the dividends on top of the premiums, like that's a very good strategy and icing on the cake if it works perfectly. Nothing is perfect. Every strategy has its limitation. But that's what Smith says based on his years of experience. So these points show us how the strategy works and how it can benefit you. And I'm going to just summarize this in terms of drawbacks first, so that we can address the critical part of it. Drawbacks of Smith's covered call strategy. I have put in a lot of points, but I'm going to quickly summarize this. Some of them are obvious. The underlying stock or asset choice is critical. The first point is the critical one. If you have a poorly performing stock, that the covered call cannot magically turn a bad stock into a good one using the strategy. Strategy doesn't, work with a penny stock or something which is not doing well. So underlying stock or the asset has to be good quality. The upside gain is limited. Any covered call strategy will have a limited upside gain. So capital appreciation plus premium income, that's your maximum gain. And Smith has to execute a similar strategy every month, and that requires more work. That's another point to keep in mind. Upside is limited, and also that this strategy requires you to write calls every month. So it's a lot of work. Requires upfront investment or capital for holding stock plus writing call. That's another thing. You need to have a sizable capital because you need to invest at least 100 shares because options are traded in lots of hundreds. So you need capital for that. Plus you need capital for margins. Plus you need capital for transaction costs and option exercise and so on. So yeah, so that explains this point. And also margin costs and transaction costs can eat up gains, and it can be significant. If your account is too small, you may lose more money in these margins and transaction cost. And in some cases, you may have lower premiums, and that can lower your income. And if the costs are high and low premiums are low, and that's a worst combination that you can have. And the same strategy or trick cannot work every time, so it's not sustainable. You cannot have just one stock and keep writing calls on it and sit and relax and do nothing. And it's not something which is repeatable. You need to have different strategies, move on to different stocks, different indices, different assets, and so on to make regular income. And if you want to make it a profession or you want to do it as a regular thing, uh, just be prepared that this is a full-time activity. It's not like a sidekick or a side gig that you can do on the weekends or at night and just forget about it. It requires a lot of work. Even professionals find it difficult to execute the strategy. They have the systems in place to take care of this, and I'll discuss that in the next upcoming page. Last but not the least, you have to diversify into other stocks or assets, continuing with the above point. But that also requires more capital. Again, diversification has to happen. Otherwise, you will be stuck with one strategy, and you make losses on that strategy, and then your game is up. Game is over. So here, if you use different strategies at different points of time, you have more options to work with. You have more avenues to work with, and that also requires more capital because if you have to do covered call strategy on 3 or 4 different stocks, you need to have enough capital to buy all those stocks and do those covered call writing on different stocks and so on. And to maintain 3 or 4 positions, you need to have that capital. So that makes it difficult for an individual to do all this, and also come up with the capital and come up with the margin and transaction cost and so on and so forth. However, this can be possible if you do it through a fund. Okay, that's the next area that we are discussing. If you are investing in a covered call fund or a covered call exchange traded fund, you are using a professional fund manager who executes the strategy for you. So you don't have to do it yourself. You don't even need to know exactly how it is working. You just need to have a broad idea what is going on. And you need to have a strong belief in the portfolio or the index or the diversified funds they are investing in. The second point is very, very critical. If you are new to this, always go with an index or a diversified fund because you don't want to go with single stocks. You don't want a single point of failure. You want to eliminate the single point of failure. Like Warren Buffett says, rule number one, don't lose your capital. Rule number two, follow rule number one. That's all. Like you don't go with individual stocks or any sectors. Just go with the index. You have a lot of S&P 500, Nasdaq, and Russell covered call funds. Choose that as a starting point, and later you can move into other areas, or even move into single stock covered call or other options that you have for investing. Thirdly, downside risk exists. Just see the difference. I'm not saying downside risk is completely eliminated. It's it is still existing, but it is cushioned to some extent. due to the premium earnings. This is the same point that I mentioned before, the shock absorber. Remember the shock absorber example? It's the same thing. You're getting a little bit of cushion or buffer, take care of those shocks. And the upside is capped, obvious, but consistent income is made. And some funds with who write out of money calls above the current price, they capture upside. We discussed already in the example that you make some capital appreciation plus you make some premium income. So that way you are making some capital appreciation plus income. And premiums can be attractive in volatile markets, and the opposite is true. In when the markets are not volatile, you may make less premiums. And it's a repeatable strategy, can be added to existing portfolio or other funds. Repeatable because there is a fund manager, there is a fund which is operating it. You're doing it yourself, it's not easy. It's very difficult to repeat the strategy. And this helps long-term investors stay on course. Since you invested in the fund, it's going on autopilot. You can reinvest or increase your investment, or at some point you want to take out some money, withdraw, you can do that. So you are focused on your long-term goals. You don't have to worry about prices moving up and down. Even if the prices move up and down, you still make the premium income every month. And plus, you make the capital appreciation also. And cut down all the noise, frequent trading, and changes. Like, focus on your overall long-term portfolio goal and go with that. In the interim, anything can happen. Like nobody can predict the markets. I'm not saying this is the best strategy. This is one of the strategies in your portfolio, and you will use this in combination with other strategies you have in your portfolio or basket. And last but not the least, once you have had your portfolio designed or structured, which includes covered calls, index funds, other funds, plus a few stocks, etc., or probably other assets including gold, Bitcoin, your focus should be to let the portfolio do its work and review that probably once in 3 months and shift the focus from portfolio investing in yourself, your career, your business, or your side hustle, your hobbies, or your talents, whatever you have in other aspects of your life, invest on that. So, with that message, I would like to say that, to address the arguments, first of all, it is difficult for individuals to do this on their own, especially in beginners or even investors who are experienced. It could be difficult to understand the complexities of the covered call. And even if you understand and even if you're able to do it, it can be pretty difficult in terms of capital management and executing the trades and executing the strategies is not easy. It's a full-time job. So you can definitely consider the funds as a safer route to follow this strategy and benefit from that. So that's my message to investors who want to look at covered call strategies. Look at covered call exchange traded funds. Pick the one which resonates with your strategy, which resonates with your goals or needs, and go with that for some time. And evaluate performance every 3 months and so on. I hope you like this video, and I hope you benefited from that. And I look forward to hearing from you. Please drop in your comments, feedback, and if you like this video, subscribe to it or give that like or share your comments or questions. Looking forward to hear from you. Thank you. Have a great day and happy investing.